Hey everyone, it's Tom here. Today I want to talk about the different types of orders and stop losses that we see when we're looking to actually place a trade. So this is something that I know every trader comes across at some point. It might be obvious to some of you, but I get it from a lot of traders. They're saying, well, what do these terms mean when I'm actually wanting to place a trade? You know, I've got things like market order, I've got things like trailing stop, etc., limit order, deal. What do I do with these buttons? You know, which one do I need to use? Basically, to get into the trade that I want to get into. So we're going to cover those now. We're going to have a look through the different options, what they mean, and which ones are best in certain scenarios. Just very quickly before we dive in, if you're still struggling with your trading, or you'd like to know more about how mechanical edges are traded, I've put together a free video course for you that will map out and explain everything in detail, along with walking you through exactly how the mechanical rules actually work. If you'd like to watch that after this video, I'll pop a link in the description. You can click through and you can watch that straight away. So let's start by defining what we're talking about when we say an order in the market. And when we use the word, or when traders use the term order, what we're simply referring to is an instruction, like an order basically to our broker to do something. We're telling our broker to perform an action. So that might be entering into a trade or getting us out of a trade. Now, if we have a look then at the two kind of popular areas for entering the market, so for actually placing a trade, they're usually called market orders or limit orders. You might be called something different. For example, if you're using IG, sometimes they're called deal and order. You'll see that come up on some other brokers. They have different terminology. But basically what we have is we have a market order and a limit order option. Now let's investigate what those two terms mean. So the first term is market order, and that essentially means we're going to get into the trade right then live in the market at the current price, or as close to the current price as the broker can get us. We'll cover that in a second. Basically, whatever price it is right now, if you click buy or sell, you're going to get in there. It's not going to be a huge delay. You're not going to be waiting for the price to hit a certain level. We're going to be getting in right then and there. And provided the market has enough liquidity, so, you know, a topic that we've covered on a previous video, have a look back through at the liquidity video if you're unsure of what we're talking about here. But provided it's liquid enough, provided there's enough buyers and sellers in the market, you're going to get filled, your order will get executed at that price level. If there aren't enough, so if the market is too small, there aren't enough buyers or sellers at that particular price point, remember, if you want to execute in one direction, so if you want to buy a certain size in the market, it has to have somebody else on the other side to sell it. And on certain markets, smaller markets, particularly individual stocks, for example, you may not get the full order executed at that correct price. You might actually get a worse price for part of the order or for all of the order. Again, only really happens on smaller markets. So if you're trading, say, the major markets, certainly major currency pairs and things like that, unlikely to run into this, but it's worth pointing out if you're finding that your order, or when you actually execute and press the button, your entry point is slightly different. So that's how a market order works. It's immediate. The next option we have is what we call a limit order. And this is basically telling the broker, wait until the price reaches this amount and then buy or sell. So, you know, you might be waiting for the price to rise up and then you're going to hopefully catch a downtrend. So you're going to be asking the broker to sell at a higher price than the market currently is at. But it could be any number of configurations. Basically, it's not getting in right then and there. It's getting in at a price that you specify. And therefore, there is a time duration associated with this because you don't know how long it's going to take until the market gets to the price you want. And this is where we look at different types of what we call order durations, because as part of the limit order, you have to tell the broker how long to leave that order, to leave that instruction there. There are a few different ways to kind of configure this. The most popular ones are we can look at just a good till cancel, which basically means that the order stays in there until it's filled indefinitely. So it doesn't matter how long it'll take for the market to reach the price that you've specified. The broker leaves the order sitting there to execute when the market hits that price. Another ones are good till the end of the day. So yeah, basically, if it happens in that trading day, it's executed. If not, the order is wiped clean. You'd need to input it the next day. Good till a certain date, etc. So you can specify that. And there's a few others as well. But the main one, good till cancelled and good till end of the day, tend to be those two most popular types of what we call like order durations. So now that we've covered entry positions, let's have a look at stops. So, a stop loss or stop order is basically an instruction to the broker to say, close the trade at this price. So instead of like a profit target, what we're looking at here is to say the trade hasn't gone in the direction we want, we're going to minimize our losses. And anybody that trades knows that we need to trade with a stop loss on every single position we take to protect ourselves. But there are a few different types of stop losses. So there's a standard stop loss, which would just work in the sense that when the price hits that level, the order's executed, we get out of that trade, but there are small risks associated with that. One of those comes with slippage, that if the price basically doesn't hit our level, it goes through it. We might not get out exactly at the level we've requested from our broker, we might actually get out at a worse level. So although this risk is quite rare, it is very dependent on the market as well. There is that small risk of slippage. And basically, for some traders, they'll want to avoid that. So another type of stop loss that we have on offer is what we call a guaranteed stop. It's basically there to protect yourselves against the risk of slippage. So it works in a very similar way to a standard stop loss. You set the price level that you want, but it will always be filled at exactly that price level. So if the market touches that price level or if it surpasses it, you will always get out exactly at that level that you specified, no worse than that. It's basically the broker taking on what they'll see as a bit of risk. There is it's usually an extra bit of fee for this. Wider spreads, for example, is a common one that you'll see with brokers, but obviously the guaranteed stop gives you a little more peace of mind. So it's worth considering, if that's something that you think is going to be a risk. The final type of stop loss we can look at is what we call a trailing stop. Now we can look at a trailing stop in two ways, manually or automatically trailing it. Let's cover the automatic trailing stop first. Essentially, what you do is you set a price level, same as you would for a standard stop loss, but if the market moves towards your profit instead of moving towards your loss, what the trailing stop will do is it will automatically step your stop loss up towards your profit by a certain amount. So let's say you've set a stop loss and you've set a step for, 10 points or so. Basically, if the market moves towards your stop loss, then that stop level you've identified won't move at all. But if the market moves towards your profit, then the stop loss will move towards your profit as well. It's essentially a way of automatically moving towards break even, for example, if you want to go for wider profit targets, or even if you want to leave the trade to run without a profit target set. Hopefully, if it's on a large trend, the stop loss will step. It will follow the way the market moves towards profit. When it eventually stops you out, you'll be significantly into profit. The other way to do this, obviously, is to manually trade it. So actually to manually move your stop loss. Now, you'll hear traders talk about never moving your stop loss. And it's absolutely true that we should never move it further away. So we should never increase our losing R. But there are opportunities where we can move it towards break even into profit, essentially manually trailing it. And so that was just an introduction to the various types of orders and stop losses that we see when we're placing trades. If you're fairly new to trading, you're logging onto your broker, these can be a bit daunting. You're thinking, well, what am I going to click here? What am I actually supposed to do? So having a look through, some brokers will be good at obviously offering you descriptions, but having a look through what each of these terms mean and what's best for the type of trading that you're going to do is absolutely vital. Hopefully that's been useful. If you'd like to find out more about kind of how we trade, book a call with one of our team, links are below. And also, catch any future videos. I'll be going through different topics on trading regularly on this channel, so I look forward to seeing you on the next video. Thanks, guys.